The thing I like about housing is no matter what happens in most scenarios is people still need a roof over their head. And when we can be in safe municipalities, safe communities with great schools, diversified employment, and all the things that families are looking for, we put down roots, that takes a lot of risk off the table. We've got heavy concessions across the U.S., here in the Midwest to a lesser extent, but still oversupply. Some markets are better than others. We still see this debt maturity wall coming where we're seeing assets that are probably going to be forced to deal with that issue coming up here. Insurance, property taxes, operating expenses, all been elevated. We're starting to see that level off, but that's certainly been a headwind.
Pricing is kind of where it was in 2019, and that's really what we're seeing right now. That's where cap rates are at right now. I don't think interest rates, really don't see them coming down. A lot of it's on the 10-year treasury, and so at the end of the day, I think we're going into a good time to buy with pricing being low and through more kind of NOI growth, more organic growth, and kind of longer hold periods.
Daily volatility persists. Yep, higher for longer. Midwest cap rates, we'll certainly get into that. They haven't really gone up much, but they haven't come back down either. Plenty of debt capital available out there. Now, some sponsors and real estate operators may not like the cost of that capital, but there is plentiful debt out there in the marketplace. New supply is definitely tapering off meaningfully. We're seeing it literally fall off a cliff in some places where supply is ground to a halt, even though there's still lots of units that need to be rented. So we're still seeing household formation. We're still seeing inaffordability in being able to purchase a home. So more renter demand coming from that being such a large gap in what it costs to rent versus what it costs to own. And so we're still in this buyer's market. Now, the flip side of a buyer's market is it's not a great time to sell, but it is a fairly good time to buy assets.
There is that appetite for the kind of older product again, where the 80s, 90s product in good locations. We used to do a lot of heavy value add, and we got away from that because the spreads just weren't worth the effort, and now those spreads are coming back. We built the business on the management side, and we're very good at that. We've also slowly started building this kind of equity capital machine, we'll call it, that has a lot of value out there.
But it has been a really good time to buy. Case in point, some of these deals we've been able to acquire lately at the price point we've been able to enter the market. But still, the number one source of new investors is current investors, and that means a lot to me. That says we're taking care of our customers and we're serving them well and we're keeping them happy, which leads to other customer referrals. In a fund, when you've got several assets, it can still not go according to plan, but the bottom of the probability tree should still result in some sort of positive returns in most conditions. And those eggs are spread out over several communities, maybe different markets altogether. So if one goes bad, you still got other diversification in that fund to help pick up the return.
Still probably 50-50. We've had some instances recently where we're working on an off-market opportunity. We don't hit pricing or the pricing that they want. They threaten us and they say, oh, we're going to go to market if you don't hit this. Like, okay, go to market. And then they call Alec back. They're like, okay, we didn't hit our pricing on the market. Are you still willing to pay what you're willing to pay? And it's like, no, now we're $1 million less.
The times of extreme pessimism and really bad sentiment in any asset class is typically the best time to back up the truck and load up on that asset. We're starting to see bigger stakes being taken in boring business. We're seeing capital going out of the AI hyperscalers, and we're seeing it go into boring businesses. That 100-year-old operating company, when some smart people come in with AI and add more efficiency and margin. So there's this shift occurring right now, and we're starting to see the capital come back into the market. My current thesis is we are in a 1940s analog. The 1940s, you had extreme political division. You had capitalism and communism, and at the time, you had similar debt to GDP, giant spending boom in defense and infrastructure. And we're seeing those same trends now in AI, data centers, power generation, all sorts of infrastructure projects. And I think the Midwest will be a big beneficiary of this. But CapEx, again, takes a while, right? It takes a while to get shovels in the dirt. Warren Buffett said it best, don't bet against the USA. Got a bright future ahead of us, but we are always watching. Instead of trying to predict the future, it's watching current market conditions and trying to see where the puck is sort of headed.
It's hard to predict the bottom and the top. The stuff in the middle is a lot easier, right? So it's like, as long as we know it's on the way down, then I can sleep well at night.